third type of revenue, capital gain. Let's start with the definition of capital gain. Capital gain is a type of revenue related to selling or the disposal or revaluation of fixed assets. The first type of capital gain is selling fixed asset. What is the meaning of selling fixed assets? The company might sell one of its fixed assets either because it has no further need for it or to replace it with another efficient asset. If the net assets exceed the net book value for the assets, the difference is considered as a capital gain subject to tax. If it is a capital loss, they are included among the deductible costs. From the tax point of view, the book value of any asset must include number of items. Number 1, purchasing costs. Number 2, registration fees. Number 3, lawyer fees. Number 4, renewable costs. Number 5, extension costs. And the recent item to be added is the interest on loan. The interest on loan is obtained to acquire the asset is a part of the book value in the case of juridical person. Remember that we are dealing with the juridical person, while in the case of natural person, it is not part of the book value. Please keep in your mind that we differentiate between the debt itself or the loan and the interest. The interest is included in a part of the book value. In order to calculate the capital gain, we need to go through 3 steps. Number 1, the net sales, which is equal to selling price minus selling expenses. The net book value, which is equal to the book value minus accumulated depreciation approved by the tax. Then the last step is calculating the capital gain, which is equal to the net sales minus the net book value. According to the legislator, capital gain resulting from the sale of all type of fixed assets are subjected to the juridical person income tax, while in the case of natural person, some assets are subjected to tax. Let's see example number 1. The accounting net profit for a tourist company in 2015 was 75,000 Egyptian pound. If you know that in October 2015, the company sold the ship for 250,000 Egyptian pound. The book value for this ship was 450,000. Remember, it is approved by the tax. The accumulated depreciation at the end of December 2014 was 225,000. The accounting depreciation rate was 10%, while the tax depreciation rate was 5%. The accounted capital gain was included in the income statement. The ship started operation in January 2010. In November 2015, the company sold an equipment for 350,000. The book value for the equipment was 500,000. And remember, it was approved by the tax. The equipment was totally depreciated by both the financial and the tax accountant. The capital gain for the equipment was not included in the income statement. Required, calculate the TMB. First number is revenue not recorded subject to tax is the 350,000. Why it is positive? It is positive because this amount is a revenue not recorded according to the given, and it is subject to tax. Why it is subject to tax? Because all capital gain is subject to tax. The second number, why it is positive? It is positive because it's expenses recorded and not approved by tax. Why it is expenses recorded and not approved by tax? Because it is recorded and calculated according to the tax, so it is expenses recorded and not approved by the tax. The third number, negative. Why it is negative? Because it's expenses not recorded and approved by the tax. From where did we get the 16,875? The depreciation expense for this ship during 2015, the 9 months is equal to 16,875. This amount is approved by the tax but not included among the expenses. So these expenses are not recorded and approved by tax, so it has a negative sign. The fourth number, expenses not recorded and approved by the tax. The 70,625 are capital losses. Capital losses are considered as an expenses. It is not recorded because it is not included by the financial accountant and it is approved by the tax. The last number, 58,750, is considered as a revenue recorded and not subject to tax. Why it is revenue recorded? Because it's mentioned in the given. Why it is not subject to the tax? It is not subject to the tax because it's calculated by the financial accountant. The second type of capital gain is the fixed asset compensation. What is a fixed asset compensation? In case of insured fixed assets, the value of compensation, if the value of compensation exceeds the net book value, it is considered as a capital gain. If the net value of the compensation is less than the book value, it is considered as a capital loss and considered as a deductible cost. The same rules of the fixed asset compensation is applied as the selling of a fixed asset. The third type of capital gain is revaluation profit. Companies either reevaluate its assets for different purposes. In the case of gaining profit from the revaluation process, the tax treatment is as the following. If the capital gain or losses of revaluation for the purpose of showing the actual value of the company, they are not subject to tax. Why it is not subject to the tax? Because it is not considered as an actual gain or loss, it is unrealized gain. If the capital gain or loss of revaluation with the purpose of changing the legal form of the company, what is meaning of changing the legal form? Changing from a sole company to the partnership, the capital gain is, in this case, will be subject to the tax. If you are changing from a sole company to a shareholding company, the capital gain will not be subject to the tax. But listen, according to the registrator, there are two conditions, very important to focus on this point. There are two conditions in order to exempt the capital gain from the tax. What are these two conditions? The shares resulting from changing the legal form must not be disposed during the first 3 years. The new juridical person or the shareholding company must keep the financial statement and records showing the book value of for assets and liability before the date of legal change. Let's see an example. A resident corporation A merged with a resident corporation B. So we have two corporations. A merged with company B. At the date of merger, the company A had a building whose book value was 100,000 Egyptian pounds. Accumulated depreciation was 40,000. The building was revalued for 90,000 for the merger. Company A had a car, its net book value at the date of merger was 200,000. It was revalued for 250 for the merger. Company B sold the building after 1 year for 150 Egyptian pound when the net book value was 80,000. Also, the company bought a new car for 150 and sold the old car for 390. Calculate the capital gain and the tax treatment for the car and the building under the following two assumptions. The first assumption, if company B didn't sell the building. Assumption 2, if the company B sold the building. Let's go ahead with the first assumption. Capital gain for the building. If company B didn't sell the building, so let's go ahead with the 3 steps. The book value according to the given was 100. The net book value is equal to the book value minus the accumulated depreciation. According to the given 100,000 minus 40, the net book value is 60. The capital gain is equal to the difference between the revaluation, because it's not selling, the revaluation amount minus the net book value. According to the given, the revalued of the building is equal to 90 minus 60, 30,000. This capital gain will not be subjected to tax. It is totally exempted. Why it is totally exempted? Because the company didn't violate the condition. What is the valuation condition? Don't sell the building. What if the company sold the building? Let's start again. The book value, but before the merger, was 60,000. The capital gain is equal to the selling price. Why selling price? Why I didn't mention the revaluation? Because the assumption told me the company sold the building. So selling price 150 minus the book value before the merger was 60, so the capital gain is 90. This capital gain will be subject to tax because the company sold the asset after 1 year. The registrator mentioned 3 years. The second case, the capital gain for the car. We have two assumptions. The company B didn't sold the car. What is the net book value of the old car? 200,000. According to the given, the revaluation amount was 250 minus the book value 200,000. The net book value, the capital gain is 50,000. This capital gain will not be subject to the tax. Totally exempted. Why it is totally exempted? Because the company didn't violate the condition. What is the condition? Not selling the asset. What if the company sold the car? I had to go back to the value before the merger. The company car, the old value was 200,000. The book value for the new car, 150. So the total value of the cars, 350. The capital gain is equal to the selling price, 390, minus the net book value is equal to 350, the capital gain is equal to 40. The capital gain will be subject to the tax. Why it is subject to the tax? Because the company sold the asset after 1 year. The fourth type of capital gain is financial market capital gain. Please remember, we have two concepts of the financial market. We have financial market return and the financial market capital gain. What is the meaning of financial market capital gain? Capital gain from financial market means the profit gained from selling any financial instruments. Sorry again. What is the meaning of financial instruments? Stocks or bonds. These profits are earned due to the difference between the purchasing price and the selling price. How to deal with the financial market capital gain? We need to differentiate between two cases, the foreign market and the Egyptian market. The foreign market situation, if the company sold foreign stocks or bonds, what is the meaning of foreign stocks or bond? Not registered in the Egyptian financial market, then the capital gain resulted from selling these stocks will be subjected to the tax. Let's see how we apply the concept of the financial market capital gain. According to the example, the resident company total loans was 20 million to finance its investment. The revenue generated from these bonds, which is a kind of the financial market, which between bracket Egyptian, was 1.5 million, and it were included in the income statement. The company's total revenue was 25 million, the financing cost was 4 million, and the net profit from the income statement was 5 million. Required calculate the TMB. Before starting calculating the TMB, we need to do our calculation. First of all, this is a case of a resident company. So if it is a resident company, I need to calculate the cost of finance, which is a non-approved part. According to the rule, the non-approved part equal to the financial gain divided by the total profit multiplied the total interest paid. So let's calculate. According to the given, the capital gain is equal to 1.5 million divided by the total revenue, which is equal to 25, multiplied by the interest paid according to the given 4 million, so it will give me 24,000. The 24,000 is considered as an expense not approved by the tax. The company is registered and gained revenue from the Egyptian stock market, so the financial market capital gain will be exempted from the tax. Let's go ahead and calculate the TMB. To calculate the TMB, I have to start with the A and B, 5 million. The first item to be added is expenses, recorded and not approved. How much is it? The 24,000. Again, why the 24,000 is added? Because it is expenses, the cost of finance. It is recorded according to the given, and according to the rule, it is not approved by the tax. The second item to be deducted is the revenue recorded and not subject to the tax. According to the given, the financial market capital gain are not subject to the tax because it is a resident and Egyptian stocks. So it is revenue recorded and not taxable, so the sign is negative. Another example, the tax base for a resident juridical company was 120,000. The total taxable revenue was 395,000. The tax base included capital gain of 180 resulting from selling securities abroad. The foreign tax paid is 5,400. Calculate the TMB. According to the given, it is a non-resident company. So remember, in the case of a non-resident company, I need to take care of the double taxation problem. The annual tax base is equal to 120. The tax due is equal to 22.5%, the juridical income tax rate, which is equal to 27,000. I need to deduct the foreign tax. Remember, in order to avoid the double taxation problem, I need to deduct the foreign tax. How to calculate the foreign tax? I need to calculate first the foreign tax percentage. According to the rule, 27,000 divided by 180, the capital gain, multiplied by the total taxable revenue. So the foreign tax percentage is 12,304. The company actually paid 5,400. I have two numbers, the actually paid and the foreign tax percentage. I have to choose the least number. According to the given, the least number is the amount actually paid. So I actually paid 5,400. It will be deducted from the tax due. So the company is going to actually pay 21,600. The last type of capital gain is the liquidation profit. What is the meaning of liquidation? Liquidation means terminating the company or shutting down the business. We have two methods to calculate the liquidation profit. Both methods are approved by the tax. The first one is the stepwise liquidation. How to calculate the stepwise liquidation? It is a process starting with the selling of fixed assets. We have two numbers, the selling price minus the tax book value. What is the meaning of the tax book value? It means calculating the book value according to the methods and the rules of the tax. The difference is either gain or loss. The second step, selling current assets. We have two numbers, the collected and the net book value. Either nil or loss, gain or loss. The third step is paying liabilities. We have two numbers, the book value first, then the cash paid. It is either nil or gain. The last item is the liquidation expenses, and it is always negative. The last step is to calculate the liquidation profit. The second method is what? Direct liquidation. Under these methods, I have to calculate the company selling price, deduct the owner's equity, deduct the selling expense. The result is either liquidation profit or loss. Thank you again.